Today, I'm going to be looking at the 4 phases of infinite banking. If you're new to infinite banking, it might be helpful for you to look at a couple other pieces of our content before you dive into this one, because this one is going to assume that you looked at a couple, you know what infinite banking is, and this is about kind of your experience as you move through the infinite banking cycle. If you're ready for that, you've watched enough videos, definitely stay tuned in, because this one is going to kind of unpack some of the emotions that you're going to feel throughout the cycle and how they are totally normal. This is the chart that I've put together for the infinite banking effect. And if this looks a little bit like another chart that you've run across in your life called the Dunning-Kruger effect, it's because it is. It just is very also appropriate for the kind of emotional roller coaster that you're going to experience in infinite banking. Now, there's 4 different phases, like I said, of infinite banking. And they are, as you see at the top there, there is the capitalization phase, which is the top of that first crest. At the very bottom of the first trough, there's the proof phase. Kind of midway between the proof and the very top, kind of along the slope there, is the expansion phase. And then lastly, at the very end there, at the kind of where it just starts to plateau at the very top again, is the legacy phase. These are the 4 different phases that you're going to kind of go through throughout the infinite banking process. And as far as the axes go on this chart, you have the y-axis that goes from top to bottom, which is the excitement that you're going to experience by doing infinite banking and by starting the strategy. And then on the bottom, the x-axis, it goes from left to right, is the experience of effectiveness. So kind of how like that gut feeling you have of like, oh, like this is working so well for me. And like I can see the benefits. I'm using the policy, yada, yada, yada. That's going to be the x-axis. And so your emotions are going to kind of swing back and forth between the two as time goes on. But I just want to let you know that it's totally normal. And I'm going to explain why you're going to feel some of these emotions as you go through each one of these phases. The first phase, as we said, was capitalization. What's capitalization? That's a great question to ask. So capitalization is when you're starting to fund your policy. Now, what are your emotions at first? Well, it's going to be exciting. Like, when you first call us, you're going to be really excited. You get it. Like when you finally make that mental leap to where you're like, oh my gosh, like it clicks. I understand like what Nelson Nash was talking about. And then after that first year, maybe for the next 4 years or so, you might still be really excited, or you might even start to, have second thoughts about it, or you start to second guess yourself. And you might be thinking, why did I do this? And I've talked to people who are in this place because all the excitement they had at first is kind of now replaced by self-doubt. And you have to remind yourself in years 2 through 5 why you did this in the first place. Now, the first phase is going to happen through about years 1 through 5. This is the cash value IRR of your policy, right? Which is the gain inside that you're going to see from the contributions you've made to the dollars you have access to, is going to, at best, probably be 0% or maybe slightly negative by year 5. Maybe you might have a slight positive if your policy broke even in year 4, but more than likely 0% to negative by year 5. And this is assuming, too, that you are max funding your policy in the way that it was designed, putting $1 into every seat. Now, what actions are you doing throughout this phase, right? You're paying premiums, but your policy hasn't broken even yet. And so in the reality, what this might feel like is, your friends are buying Teslas on credit. You're dumping cash into a policy that on paper has lost money in years 1 through 5. And this requires faith in the math that this long-term strategy works, okay? Now, the key concept here is you are capitalizing the bank being the life insurance policy. You cannot borrow what you haven't stored, and you're waiting for that cash value to hit critical mass. So this is such an important phase. It's so important, and you just have to remember to hold on to that joy and that exhilaration that you had at the very beginning. Now, this, as you see here in red, this is going to be where that first phase takes place. So this is years about 1 through 5. So it starts at the very top there when you begin to capitalize. You're so excited. And then, it might drop off a little bit for the first 5 years because you're like, oh man, on paper, you're like, it just hurts to see that you haven't actually made money beyond what you've put into the policy. And then you start to second guess yourself. It's normal. It's okay. Just remember, this is a long-term strategy. This isn't a 5-year strategy. This is a lifetime strategy. Now, what's the phase 2? It's the proof stage. This is when you start to see the proof in the pudding, right? Like you start to see evidence of what you've been thinking about and hoping about for so long. And so this is you start to experience a little bit of nervous excitement here. And so the time frame here is years 5 through 10. So we've now more than likely broken even, and you start to see a little bit of the gain that you had wanted to see when you signed up for essentially going through this process. Now, the cash value IRR during this time period is going to be somewhere probably between 0% and 3% based off of your initial contributions for the first 5 years. So you're going to start to see those positive numbers inside the cash value of your policy. Now, maybe you take during this time period your first policy loan to buy a depreciating asset, like your friends were buying those Teslas. Maybe you buy a car, or maybe you pay off toxic debt like credit cards, revolving debt. Now, the reality is you're going to feel during this time the pain of paying the insurance company interest and the premium. But then you are going to see the annual statement, and you see that the cash value grew despite your loan, which is going to feel really good. So this is the proof phase. And the key concept here is that you realize that by paying yourself back and adding the delta, right, between the bank's best lending rate that you could have gotten outside of your policy and the policy loan back into your policy, that you're going to recapture some of that interest that would have otherwise gone to the bank. And this is the power of infinite banking, is you're trying to recapture some of that interest back into your own economy. Now, here is going to be the phase of, the proof phase, which starts kind of at the bottom of that trough, and then it starts to go on this upward slope where you start to feel better. And so your excitement, as you see now, is rising. You're starting to get more excited, and your experience of the effectiveness of your policy is going to start to increase because you start to use it. And you're like, okay, like I see what they were talking about. Like this is what I wanted to have happen. And you start feeling better and better about your policy. Next phase is the expansion phase, and couldn't come up with a really amazing title for this, but expansion is kind of the best that I could do. And this is basically when you aren't just using your money to either pay off bad debt or buy a depreciating asset, but you're using this to invest in an income-producing activity. Now, so your emotions here, so you're a little bit aggressive, you're opportunistic, you see this as this Swiss Army knife that you have in your back pocket, and you're using this to become wealthy. Now, time frame-wise, think like years 10 through 20. Now, cash value IRR by this point, beyond what you have contributed up until now, think like 3 to 4.5%, which once again, this is a tax advantage true 3 to 4.5%. This isn't like an average rate of return 3% or a taxable number. This is a tax-free number. All right. So amazing. You're starting to see some of that above average growth beyond what you could have gotten in like a high yield savings account over the same time frame. This is where you start to see it. Now, action-wise, you stop buying liabilities like cars and you start buying assets. We're talking real estate, private lending, business inventory, etc. And your policy becomes a pass-through entity where money flows in from your job into the policy, out to an investment, and then the investment profits flow back into the policy, and it becomes one big circle. Now, the key concept here is that $1 is doing two jobs. It's protecting your family with the death benefit, and don't forget the death benefit. Death benefit is so important this whole time. And it's now funding your business in the cash value. And so this right here is the expansion phase. And as you see now, your experience of the effectiveness of this has gone way up, and your excitement has also gone way up. And you're all pretty much as excited now as you were when you started this about 10 to 20 years ago. And then lastly, phase 4 is the legacy phase. This is the final phase of your policy. And this is going to be like year 20 onwards. And this is the phase at which you can all of the fruit of your labors for the first 10 to 20 years really start to bear that fruit, and you get to enjoy just this really amazing, very well-funded, and very well-endowed policy. Now, emotions you might experience is very peaceful, delightful, right? Like this is now the thing that you had set out wanting to do, and you did it. Now, time frame, like I say, 20 plus years at this point. Now, cash value IRR by this point, it could be north of 4.5%. It could even be in the low fives, depending on the style of your policy and the manner in which you funded it. It's a very healthy IRR over that length of time for effectively what it is, which is an incredibly liquid savings tool. Now, action-wise, maybe you might stop paying premiums and you might do like an offset or an RPU, or maybe you even start taking income via withdrawals or loans to supplement your retirement income. Now, the compounding curve is beautiful. You're living tax-free off the equity, and when you die, the death benefit is going to refill the family vault for the next generation tax-free. And you've effectively removed the outside banking system from your family's equation permanently. Think about that. And so here's the last phase, the legacy phase you see over there on the right-hand side. So this is the point at which you're even more excited about it than when you started, and it is now experience. Your experience of its effectiveness is invaluable. Like you couldn't imagine not having it by this point. And this is kind of the best point to be at in the process. Now, what's the upshot to all of this? Is that the emotions you're going to experience as you go throughout this process are normal. It doesn't mean you made a bad choice in the beginning. It's totally reasonable based upon what's happening inside your policy. Now, don't lose hope in years 2 through 5. I've seen people lose hope. Don't lose hope, because ultimately this is a long-term strategy. This isn't a 5-year strategy. This is a lifetime strategy. This is a critical stage which involves putting your head down and committing to what you originally signed up for, to saving no matter what. And remember the Swiss Army knife, right? That this is a tool that does multiple things. It doesn't just do one thing. It's not just the savings aspect inside the cash value. It's also the death benefit. It's also the tax advantage nature of it. It's also the creditor-predator lawsuit protections. This is a multifaceted tool. Do not forget that. Now, write down why you originally signed up for this. Put it in a postcard, put it on your refrigerator, put it, in your journal or something, just to remind yourself why you did this. Ask the coach, whichever one of us helped you go through this process. Email us, ask us if you forget, ask us, and we will gladly remind you. And never forget the value of the death benefit. It's not just a savings account. Remember, this is fundamentally a life insurance policy. Never forget the fact this is life insurance. This is ultimately capturing the value that you represent to the people who depend on you the most, or the things that you care about the most. And your emotions will eventually catch up with you, I promise, and it won't feel like just such a mental exercise to do infinite banking, and you're actually going to feel it and see it inside your policy. So that's a run through of the 4 phases of infinite banking: capitalization, proof, expansion, and legacy, and the emotions that are going to go along with it. If you need to watch this video again, please do. Thank you for watching. If you want to talk to a wealth coach here at Better Wealth about starting the capitalization phase, we'd love to talk with you, love to figure out what your goals are, that sort of thing. Thank you so much. Appreciate you. Bye-bye.